Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden in corporate filings, and if you are not careful, you might just learn something valuable about money and business. Today we're diving into Saratoga Investment Corp. Its latest filing. Stick around because we're going to break down a significant new deal and what it means for their future. And hey, before we get started, if you appreciate getting straight insights from these dense corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below where we go even deeper on these topics, so join us there. Alright, let's get straight into it. Saratoga Investment Corp has just filed a report that tells us about a big new financial move they've made. This is a filing with the US Securities and Exchange Commission, or CC for short, which is their way of keeping the public informed about important company events. The specific report we're looking at is a Form 8, which is used to announce major events that shareholders should know about. The key date here is the 6th of February 2026, marking the day this important information became official. The company we're focusing on is Saratoga Investment Corp. They are incorporated in Maryland and have been assigned a commission file number and an IRS employer identification number. Their principal executive offices are located in New York City, and their main phone number is 212-906-7800. Now, let's talk about what is registered. They have common stock with a very small par value of $0.001 per S hair. You can see the ticker symbol for this is SAR, which is traded on the New York Stock Exchange. They also have 6.00% notes due in 2027, traded under the ticker SAT on the New York Stock Exchange. Then there are 8.00% notes due in 2027, with the ticker SARG also on the New York Stock Exchange. They've also got 8.125% notes due in 2027, with the ticker SAY on the New York Stock Exchange. And finally, 8.50% notes due in 2028, which you can find on the New York Stock Exchange under the ticker SAS. Saratoga Investment Corp is not checking the box to be considered an emerging growth company. This means they are likely older and more established. The main focus of this report, item 1.01, tells us about a significant new agreement they've entered into. So what happened? Saratoga Investment Corp, or the company as they call themselves here, along with us Bank Trust Company acting as trustee, entered into something called the 16th Supplemental Indenture. This is basically an addition or modification to their existing base indenture, which was originally put in place back in May 2013. Think of it like adding an amendment to an already existing contract. This new agreement is all about the company issuing and selling $100 million worth of new debt. These are called 7.50% notes due 2031. This whole event is being referred to as the offering. Let's break down these notes. They will pay interest at a rate of 7.50% per year. This interest will be paid out every 3 months on specific dates: the 28th of February, May 31st, the 31st of August, and the 30th of November, starting on May 31st, 2026. So if you hold these notes, you'll be getting a regular income stream. These notes are set to mature on the 6th of February, 2031. However, the company has an option to pay them back early. They can redeem them either all at once or in parts anytime on or after the 6th of February 2028. When they do, they'll pay back the face value, which is called par, plus any interest that is accumulated but not yet paid. This gives Saratoga flexibility to refinance if interest rates change. Why did they issue these new notes? Well, the money they get from this $100 million offering, along with some of their own cash, will be used to pay off their existing 4.375% notes that are due on the 28th of February 2026. This is a smart move to manage their debt, likely refinancing older, higher cost debt with this new, slightly higher interest rate debt. But it also extends their maturity well into the future. Now let's talk about how these new notes stack up against other debts. They are unsecured, meaning they aren't backed by specific company assets. This means they rank equally with other unsecured and unsubordinated debt the company might have now or in the future. They are also senior to any debt the company might issue later that is specifically designed to be lower in priority. However, they are effectively behind all secured debt because if the company defaults, those secured lenders get paid first from the collateral. And crucially, they are structurally subordinated to any debt held by the company's subsidiaries. This means that if a subsidiary has debt, that debt gets paid before any funds can flow up to the parent company to pay off these notes. This is a common structure for businesses that use subsidiaries. The agreement also includes certain promises or covenants that Saratoga has to keep. One of the key ones is to comply with specific sections of the Investment Company Act of 1940, even if they are no longer officially registered under it. They also have to provide financial information to the note holders and the trustee. If they stop filing reports with the SEC, these promises are there to protect the investors. This offering was made using a previously filed registration statement. The deal officially closed on the 6th of February 2026 after deducting things like underwriting fees and other expenses. Saratoga Investment Corp actually received about $96,375,000 from this $100 million offering. It is normal for companies to not get the full face value due to these fees. The report is letting us know that this description is just a summary and the actual full agreements are available as exhibits. This is standard practice to provide completeness. This next section, item 2.03, basically says that the information about this new financial obligation, the notes, is already covered in item 1.01, so there is no new information here to add. And finally, item 9.01 lists the exhibits filed with this report. We can see here that exhibit 4.2 is the 16th supplemental indenture itself, dated as of the 6th of February 2026. Exhibit 5.1 is an opinion from a law firm called Evershed Sutherland. Exhibit 23.1 is the consent of that same law firm, which is often included within the legal opinion itself. And Exhibit 104 is the cover page in an interactive data format, making it easier for computers to process. The report is signed on the 6th of February 2026, and it is signed by Henry J. Steenkamp, who holds several important titles: Chief Financial Officer, Chief Compliance Officer, Treasurer, and Secretary. This shows a high level of responsibility for this filing. So, what does all of this mean for Saratoga Investment Corp? They've successfully raised $100 million by issuing new debt. They're using this to pay off older debt, which is a common and often wise financial strategy to improve their debt structure and potentially lower their overall interest costs when managed correctly. They've extended their borrowing runway out to 2031. However, it is important to remember these are unsecured notes, meaning they are riskier for lenders than secured debt. Also, the fact that they are structurally subordinated to subsidiary debt means that if any of their subsidiaries face financial trouble, the parent company's ability to pay these notes could be impacted. The covenants they've agreed to are designed to protect investors, ensuring Saratoga continues to operate responsibly, particularly regarding their status as potentially an investment company. The net proceeds received, while less than the full $100 million, are standard for debt offerings due to fees. Overall, this filing shows Saratoga Investment Corp actively managing its debt obligations. They are refinancing existing debt with new debt, which can be a sign of financial prudence, allowing them to manage their maturity dates and interest payments more effectively. The key risk here is the unsecured nature and the structural subordination, which investors need to be aware of. It's a strategic move to manage their capital structure for the long term. Alright, that is our breakdown of Saratoga Investment Corp, its latest filing. What is your take on these new notes and what they signal for the company's future? Do you think this was a smart move to manage their debt? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives into corporate finance. Don't forget to check out our Discord in the description to continue the conversation. Thanks for watching, see you next time.